Hey everyone, welcome back to Money Moves Malaysia. Today, we're tackling a common question: is insurance an investment? Spoiler alert, no, it's not. But let's break it down and understand why. We'll also take a closer look at endowment plans, education plans, and investment-linked plans. You might have heard that investment-linked plans seem cheaper and offer flexibility, but have you ever wondered why they're so aggressively marketed? And what about whole life insurance and critical illness plans? These policies actually return money in the form of surrender and maturity value, while investment-linked plans might not even have a maturity value at all. What is insurance? Insurance is a financial safety net. You pay a premium, and in return, the insurance company covers you if something unfortunate happens, whether it is an accident, a critical illness, or even death. The primary purpose of insurance is protection, not profit. It is about reducing financial burden when life takes an unexpected turn. If you never need to make a claim, that is actually a good thing. It means life is going smoothly. But if something happens, your insurance is there to provide financial relief when you need it most. Why insurance is not an investment? Many people think, if I am paying for insurance, I should get something back. But insurance is not designed to grow your money the way stocks, property, or other investments do. Think of it this way. If you buy health insurance, you do not expect to make money from it, you expect it to cover your medical expenses. If you buy life insurance, the payout goes to your family, not to you. When you start treating insurance as an investment, you risk overpaying for policies that do not give you the financial returns you expect. Worse, you might miss out on better investment opportunities elsewhere. What about endowment and education plans? Endowment and education plans combine savings with insurance. You pay premiums over a fixed period, and at the end of the term, you receive a lump sum payout. Sounds appealing, right? But here's the reality. The main reason people buy these plans is to surrender them later for a profit. Since these plans offer returns, the insurance coverage is typically lower. A portion of your premium still goes toward insurance, which reduces the actual returns. Essentially, you are getting the worst of both worlds: lower coverage and lower returns. Many parents believe education plans are a must for their child's future, but in reality, the returns are barely ahead of inflation. Investing in unit trusts or exchange-traded funds often yields better returns and provides more flexibility. Investment-linked plans, the two-in-one option? Investment-linked plans combine insurance with an investment component. Part of your premium goes toward insurance, while the rest is invested. It sounds like a good deal, but here is what you need to know. Investment-linked plans have high fees, including insurance charges, fund management fees, and policy charges. As you grow older, the cost of insurance increases. This means more of your money goes toward paying for coverage, leaving less in the investment portion. Over time, the rising insurance charges can eat into your investment, reducing its value. In many cases, policyholders have to either top up their premiums or reduce their coverage just to keep their plan active. Why do whole life insurance and some critical illness plans offer returns? Unlike investment-linked plans, whole life insurance and some critical illness policies come with a guaranteed surrender value. This means that if you do not make a claim, you may actually get some money back. Here is why. Whole life policies accumulate savings over time. If you surrender the policy after paying for a considerable period, you can receive a portion of your premiums back. Some policies offer bonuses and dividends, increasing their cash value. Unlike investment-linked plans, where costs increase with age, whole life and critical illness policies typically lock in lower premiums when purchased young. However, the guaranteed cash value may not provide great investment returns, especially when considering inflation over time. While these policies may return some money, it is important to remember that they should not be treated as an investment. They serve as protection first and foremost. Why are investment-linked plans marketed so aggressively? If investment-linked plans are not the best investment option, why do we see them everywhere? The answer is simple: they appear cheaper when you are younger, and they offer flexibility in terms of add-ons. Many investment-linked plans allow you to bundle multiple types of coverage such as critical illness, medical insurance, and accident protection into one policy. This creates a sense of convenience, and buyers perceive it as a cost-effective all-in-one package. However, adding extra benefits increases the total premium, which means higher commissions for insurance agents. This is one of the reasons why these plans are heavily marketed. Additionally, many customers like the idea of getting something back from their insurance. Investment-linked plans are often sold with the promise of investment growth, even though the rising insurance charges can eat away at that investment over time. Why do investment-linked plans seem cheaper than whole life insurance? Investment-linked plans often have lower starting premiums, making them look more affordable. But there are hidden costs to consider. 1. The cost of insurance increases with age. The initial premium may be low, but it is not fixed. As you get older, more of your money goes toward paying for insurance rather than investment. In contrast, whole life policies have stable premiums, offering long-term predictability. 2. The investment portion subsidizes insurance costs temporarily. In the early years, returns from the investment component may help offset insurance charges. But as insurance costs rise, the investment portion is drained, often requiring additional payments to maintain coverage. 3. Policy fees reduce investment growth. Investment-linked plans include fund management fees, policy charges, and insurance costs, all of which are deducted from your investment. Over time, these expenses make it difficult for your investment to grow significantly. So, should you avoid investment-linked plans entirely? Not necessarily, it depends on your financial needs and when you enter the plan. For younger individuals, investment-linked plans may offer some benefits, as their lower insurance charges allow more money to be invested. If held long enough, the investment portion could potentially offset rising insurance costs. However, these plans are not a one-size-fits-all solution. It is crucial to compare costs, risks, and flexibility before committing to a plan. So, what's the better option? If your goal is purely protection, consider term life insurance and a standalone medical card. These options are typically cheaper, straightforward, and do not mix insurance with investment. If you want long-term coverage with some guaranteed cash value, whole life or standalone critical illness plans might be worth considering. However, always compare them with other savings options before deciding. If your main goal is to grow wealth, it is best to invest directly in stocks, unit trusts, or exchange-traded funds. These options provide better returns and lower fees compared to mixing investment with insurance. Trying to combine both in one product? You will likely end up paying more and earning less in returns unless the policy offers benefits that are otherwise unavailable. If you do opt for an investment-linked plan, it is best to treat it purely as insurance and not rely on it for investment growth. To conclude, insurance is about risk management, not wealth building. If you want to invest, choose proper investment vehicles. If you want protection, get the right insurance coverage. What do you think? Have you ever been sold an insurance policy as an investment? Share your thoughts in the comments below. And if you found this video helpful, do not forget to like, share, and subscribe to Money Moves Malaysia for more insights. See you in the next video.